Hey everyone, welcome to another edition of the Buddy Study Group. And today we're going to be talking about a topic that I don't think you can go very long without hearing about, and that is how to navigate long-term care rate increases. Now, I think this is a topic you are unbelievably intimately familiar with if you've been around a while. But regardless, if you're any sort of long-term care professional in any capacity, you are generally going to hear about rate increases one way or another. Either a new client you get introduced to has talked to some friends and said, "Well, my policy had a rate increase, and I'm upset about that," and that kind of carries on. I think you may read articles out there talking about um, rate increase history on long-term care policies, and that always generates some buzz as negative articles are much more likely to do than positive ones. But regardless, I'm sure many of you are dealing with these conversations, if not regularly, at least a couple of times a year. I always talk about being really grateful for some of my previous experience working with BGAs, really right at a sales desk. That experience gave me the opportunity to consult on hundreds upon hundreds of rate increases for a BGA that had a huge book of business. Started to notice some trends. At first, the conversation was uncomfortable. Then it started to get really comfortable, and then I felt like I was able to kind of boil down my process a lot better once I've had a few. So I want to go through just my thoughts, tips, best practices for navigating rate increase conversations. And I want to hear from you guys because you have a wealth of experience in this topic as well. I want to understand how you're navigating the rate increase conversations. If you have any interesting case studies, I'd love to hear from you as well on that. Um, and we'll just see what we come up with. And hopefully, those who are here and watching the recording can leave with a couple good things they can take with them for the next discussion and any discussions going forward. So, number one, when I think about talking to a client who has had a rate increase and trying to advise them on what their kind of best decision is, it's an emotional conversation. It starts as an emotional conversation. It's very kind of similar in emotion to that conversation where one spouse is approved, one spouse is declined, right? And you got to kind of talk the client off the edge a little bit, so to speak. When a client receives a letter saying that the premium they've been paying for all these years on their policy is going to increase if they want to keep the same amount of coverage, you can totally understand how they feel about that, right? It goes with anything that you're paying for. If the Netflix subscription goes up, people get emotional, right? At the end of the day. And I think the most important first step that you have to understand if you want to get good at having these conversations is being able to meet the client where they're at and understanding their emotions, why they have these emotions, and knowing that those emotions are okay, right? We didn't sign up necessarily to be therapists, but I think it's a little bit a part of the job here in play is being able to help people understand that it's okay to feel frustrated or upset with a rate increase. You really have to meet them where they're at. It is disheartening, it is frustrating. You can have, sort of feelings of betrayal or something of the sort. It's really the first step to getting them on board to understanding what's happening. If you can level with them, they will be able to listen to you a lot better if you can make them feel like you understand where they're coming from. First and foremost, it's a very human thing. So we have to kind of bring that human element into things so that we can keep the conversation going, right? At the end of the day. Um, and then, of course, one of the major things we want to do is take an opportunity to review their current benefits, right? So this is something you're generally doing every year for many of you. Policy reviews are kind of a common thing in the long-term care and the insurance space in general. It's good to meet once a year just to say, hey, is this still accomplishing what we want it to accomplish? Do we need to make changes, right? So this is yet another opportunity to just review their current benefits and understand their financial picture and you know, really make sure we're still in a good place with our plan outside of the rate increase, right? That's an important thing to go over with the client. Remind them of the policy's purpose. I mean, if this is somebody who does not generally want to sit down for regular reviews, or it's a client who you've had trouble communicating with, and since they've gotten some bad news, this is the first time they reach out to you, remind them what the policy's purpose is. It's to provide asset protection. It's to help them pay for professional caregiving should they need it. And regardless of the rate increase or not, the policy is still going to serve its purpose, right? So reminding them of that, reminding them that it's here to help their family, right? If something should happen to them, they need extended care. It's to also help their family and, again, keep their assets intact. So that is, again, another important piece. Just review the policy and kind of remind them of the why, right? Super important to remember why we bought this from a personal level. And we have, you know, people like Rhonda Bills on the study group all the time. No matter what presentation she's doing, she always seems to open up with, we need to understand the why for purchasing this policy. We need to find each client's individual why. And taking notes on that is a really good practice, right? When you can understand the client's why, you can always refer back to it, including times like this, right? When you have a rate increase that you're needing to deal with, the client's emotional, their first instinct is probably, I just want to drop this stupid policy. Now it's just kind of causing me issues. It's getting more expensive. You gotta tie them back to their why. Why did we purchase this in the first place? What important things is this taking off your plate or giving you peace of mind about is super, super important to remember in the first place why they thought it was a good decision to move forward with a policy. And then I think when it comes to the rate increases come in all different shapes and sizes, but there are still some things we can educate the client on. And hopefully, this is something we're also doing as we're selling the plan, to get them to understand why rate increases happen in the first place, right? So teaching them a little bit about the history of the industry can help go a super long way in helping them understand why this rate increase is happening. They're not just picking on you. They're not just saying, you may cost us a little too much money, so we're going to make you pay more. That's not why rate increases happen. It's not legal for companies to just pick out a person and levy a rate increase on them, because of their particular experience or who they are or likelihood of needing care now. None of that is really part of the picture here. So giving them an idea of where we've kind of come from as an industry is super, super helpful. So, in telling this story, you get to a point where you're essentially arriving at the fact that their policy is a great deal. It's underpriced. When the carrier first sold you this plan, and you made the decision to go forward. You bought essentially an underpriced policy, and you've held this policy with a very good deal, underpriced, for years and years and years and years. It's not often that the consumer gets one over on the insurance companies like that, but congratulations. That's exactly what's in play here, and that's exactly why you have a rate increase. So, essentially, why the carrier is choosing to levy a rate increase or trying to levy a rate increase today is because they have found that their claims, the money they're paying out in claims, is out of whack with the amount of premium dollars they have received, essentially. So because your policy has been underpriced for so long, because the carrier has seen a number of claims and are paying out lots of claim dollars, they need to petition the state insurance department to ask for a rate increase on their entire policy generation, their entire block of business, so to speak. So this is not just the insurance company picking on you in particular. It is by state, all of the policies that were sold in that policy generation. Um, so yes, the insurance industry, the long-term care industry, this particular carrier that we're dealing with made some mistakes in their assumptions that led to how they priced the policy. Essentially, um, back when long-term care was in its infancy, actuaries thought that clients would drop their policies far more often than they actually did. Essentially, this is lapse rates, right? So the carriers thought that lapse rates would be somewhere around health insurance rates, right? They thought just about as many people would drop their long-term care policy as would drop whatever other health policy they have. And they turned out to be wrong. People retained, held on to their policies, and used them as we direct them to, and that they should, right? At the end of the day. But unfortunately, the formula they used to price the product led to it being underpriced for years. You've gotten a great deal up till now, and they've had to ask for a rate increase because they are in this position financially where they are paying out a lot of claims dollars and not getting enough premium dollars to kind of recoup those claims losses. So I think all this being said, however you choose to lay out the history, you need to bestow a perspective on the client. They've come in angry, upset, frustrated, and you need to kind of turn this into you've gotten a great deal, and making the decision you made at the time you made it was an excellent decision. And you ended up getting massive value, you know, proportionate to what you were paying for that policy. So the reason you're here is because you made a decision that is so good that the carrier actually has to try to recover from that good decision, times however many policyholders, right? Um, so taking that into account, lapse rates, underpriced policies, and extremely robust benefits, right? Benefits like 5% compound, benefits like lifetime unlimited benefit periods. Those tend to be kind of the most problematic policies for insurance carriers because the benefits are so robust, or in many cases with lifetime unlimited benefits, don't end for 8, 12, 16, 20 years, however long your claim is. That's kind of an unforeseen future as to how long they'll be paying out claims. 5% compound provides so much benefit growth that it extends out, the amount of payment. It extends out proportionately your benefit period, even on a reimbursement plan, right? If your monthly benefit is greater than what you're paying for care, it proportionally extends out your benefits. So those policies in particular, those older policies, provide a ton of value. And if you're meeting with clients and consulting on rate increases for plans like that, it's important to get them to understand how great of a plan they have beyond getting an underpriced plan, right? In many cases, you can't even get what they have on the open market today, or if you can, that the amount you would have to pay to have that sort of protection today is exorbitantly expensive, right? Carriers legally have to offer 5% compound in many cases, but many of them are putting those types of plans on shelves that people can't reach, right? They don't really want to offer 5% compound. They don't want to offer attractively priced 5% compound in many cases on the individual market. Um, so they need to understand the power of what they have. One of the best ways, I think, to do this and to really, again, give perspective on how underpriced their plan is take what they currently have in benefits and take the premium they're paying and try to quote a product that is on the market today for those same benefits and see what the premium comes out to, right? And you can do this in a couple of ways. You can quote it at their current age. This is what it would cost to say move to another carrier at your age today. This is what it would cost to have similar benefits, but you can also do it at the issue age they bought the policy. You bought this plan when you were 45, it had X benefits on it. If a 45-year-old today tried to purchase the same benefits, it would still be exorbitantly expensive, right? That gets them to understand how underpriced their policy is and really starts to move them in that direction of, huh, I think I actually did make a really good decision. And given what somebody on the market today would have to pay to get what I have, I'm starting to understand the value a little bit better, right? And then you have to, once you've kind of demonstrated the value of their current coverage, you still have a decision to make at the end of the day. So the client gets a letter. Generally, there are several different options that they can do to reduce their coverage and keep premiums down, keep the rate increase amount lower, or keep premiums right where they were at what they were paying, but with reduced benefits. There's lots of different options they can actually interface with. And I'll tell you, for those older plans that have you know, really cheaply priced 5% compound or lifetime unlimited benefits, you really have to do some soul searching because these are super valuable benefits that you don't want to give up unless you absolutely have to in some cases. But for some folks who are getting older, who are on a fixed income, who, maybe the premium was getting a little troublesome already before the rate increase, they may have some decisions to make. They may have to modify some benefits. But for many folks with older policy generations, and let me know if you guys have the same experience, but I would say 95% plus percent of the time that I am talking to a client with one of those older plans, the answer ends up being if you can still afford this premium post rate increase comfortably, you should continue to pay the premiums and keep the benefits the way they are. Happy to hear if others have different experiences, but in many cases, even post rate increase, they're going to be paying a lot less than, again, what a new policy on the market today would cost. And they're still getting a tremendous amount of value from those plans should they need any sort of extended care. So, in many cases, I'm telling people to keep their benefits the same if they can afford that premium comfortably, but if not, you can try to scale back a few things. You can try to reduce the inflation protection if you're on 5% compound and see if there's maybe a 3% compound, or if they're of a certain age where inflation protection may not be as important, they don't have longevity in their family, maybe you drop the inflation protection to zero. Keep that lifetime unlimited benefit, keep the benefit growth in place if you can. Um, and if they don't have lifetime unlimited, maybe you can scale back another year, another 2 years. But I generally don't like messing with benefit growth that they have earned through paying the premium in many cases. So it's always under the condition that they can kind of maintain that benefit growth that they've earned. But I'm interested in hearing, and let me read the chat. I don't have any eyes in the chat. Um, I want to hear from some of you guys in what you're generally advising, or if somebody really needs to reduce premiums, what are you generally looking at first to reduce benefits to keep the premiums um, amenable for the clients? Anybody have any insight there? And Chris says in the chat, in the PNC business, I used to have mid-year reviews to discuss benefits, also to prepare for rate increases. But we know we have the coverage the way you want it. If they called and complained, I reminded them of our review and asked what part they wanted cut out. Yeah, I think that's a really good practice. I think reviews will definitely help curtail the surprise that a rate increase can introduce. Um, but I think overall, my process is meet the client where they're at. right? Understand what they're thinking, what they're feeling, and help them realize that that's normal. Number two, give them an idea of why this rate increase is happening, teach them a little bit about the history of the industry and why that has kind of led to a rate increase. But number three, really bestow that perspective upon them and use the numbers to show them. This is also partly to congratulate you. You've got a policy that's extremely underpriced for the benefits you're getting, and I can show you that by taking a look at the market today. But as far as options, as far as working through that rate increase letter, anybody dealing with rate increases pretty regularly, do you come out to the same kind of assumption that I do, that in many cases, if you can afford the premium comfortably still post rate increase, they should pay the increase? Or do you find yourself tinkering with benefits a little more?
Hi, Jason. Uh, I'll
Hi.
make I'll make a comment. It's Lori Gogler.
Hey,
There.
Lori.
Hi. So one thing that I have found really successful, and when you're talking about, making a change to the premium or to the policy structure, so much of it depends on their finances, their
Right.
age, their health. But one thing that has really helped me a lot, and I know that we're all getting I mean, I have stacks of them that have to be scanned. It's just
Sure.
awful. One thing I do is I call the carrier and I have them tell me um, how much money has the client paid in premiums over the life of the policy? And then I ask for the full, I call it a long-term care bank account. How much money is in that long-term bank account? And then if you do the math, where the numerator is the total amount of money in the bank account divided by what they've paid in premiums, you come out with a ratio that
Love it.
basically tells you for every dollar of premium you've paid, here are here's how many dollars of care you're getting. So they see this, what we know is a giant discount now, because most of what I'm seeing when I do this, and I do this calculation regularly, and I know through um, the buddy system, it also does a similar calculation.
I was
That's
going to say, Mark Glickman would
sure
be
too.
very, very proud of your answer because you're essentially calculating their in-force insurance multiplier,
Yeah,
right?
which is what Buddy INS does as well. So when I tell them what their number is, and I'll say, do you realize this? And I say, like, you were brilliant because here's the number I'm getting for a similar, when you bought the policy back then, you were whatever 60. And for this kind of policy structure, here's the ratio I'm getting. So
Yeah,
pat yourself on the back. Now let's talk about affordability. And of course, if they can afford it, then they're understanding the value better.
right.
That's been a real um, you know time saver for me without having to just go through so many scenarios for reducing or whatever. So that's
Yeah,
it's
and you compare that to any other sort of traditional financial vehicle that they may have, and how often are you getting that amount of return on your investment or that amount of total value from your
Yep,
investment, right?
yep.
So I can tag on to what Lori's saying.
Yeah.
I think that's excellent. And I always do, Jason, show them what it would cost to buy the same thing. And I always use issue age. I
Yeah.
always use
Yeah.
issue age because that's so high. But
Yeah.
I'll tag on to what Lori says. When I know what their bank is, their benefit bank, then depending on their age, I want to project that out to 82, 85, depending on their longevity. And I look at, of course, what kind of inflation they have. And I use my very simple, because I'm an English major, okay? I put that, my money gym calculator, and I can put that in and then use zero on the second line. And then I put 3%, 4%, 5%, whatever it is. And I say, okay, here's what you're projected to have. Of course, you could have a claim any day, but here's what you're projected to have at the average claim age. Okay, which is
Right.
like 4 for women, 82 for men. And then I look at, okay, here's what you've already paid, here's what you will pay, assuming there's no more rate increases, which I can't guarantee you that
Right.
won't happen. But, compare that number, what you've paid with this number at age 82 or 84, and it's usually no contest. I
Yeah.
have sold 99% rate increases doing all
Y-
that.
Yeah.
Now, there are exceptions because there are, and of course, if they can afford it, I recommend they just keep it. Okay. But if they can't, I've got a lady right now. She's 68 years old and she's been having the series of Genworth rate increases. She can afford this one, but she will ultimately drop this policy.
Right.
I know she will because the rate increases will keep coming. So I have suggested to her at her current age to go over and grab Manhattan Life because no waiting period and a ton of benefits, 400 a day, 300 for home care, and it'll restore. She might get 2 years, whatever. But I would rather have her able to afford something that I know she can keep, even if there's some rate increases on that, versus I know she's going to drop that Genworth policy.
Yep. And both super great approaches. And I think what you say, Lori and Phyllis, really brings to light how important long-term care specialists are because it takes a really good consultant to get somebody to make the decision in the first place,
Yeah,
number one.
yeah,
But it takes a really good consultant to also remind them and get them to re-understand what they have and the value and keep them, if not in the same plan, which many people will generally end up in that bucket, but even if not financially viable, to get them something that suits their situation now or to modify what they have to fit their financial situation now. So
yeah.
you're a consultant all the way through.
Romeo just said, virtually the same thing. But here's the thing, when you start cutting benefits, you never, ever, ever want to do the 180-day waiting period.
Agreed.
There's little difference in premium. Don't even
Agreed.
think about that. But now, if say that they're wanting to cut the benefit period, one thing I do is, okay, you're going to cut it from 5 years to 3 years. Is that what you're looking at? Okay. So here's how much you're going to lose in benefits, and here's how much you're going to save in premium.
Yep.
And it's, chicken feed almost. But again, you have to adjust that. And now some of my clients have daily benefits of almost $500 a day
Right.
because of how long they've had the policy. And depending on where they live, they may be able to reduce that. Or
Yes.
it might make sense to cut the benefit period because that daily benefit is so high that their 3 years will last them, 5 or 6 years. So it's individual
And
consideration.
and one thing I'm hoping that the audience can help me out on too, because you all have a lot of experience in this realm, is that the client gets a letter. The letter has a menu of options, but just like Starbucks, there's a secret menu
Yeah.
of other modifications they can make to their policy. And I think every carrier has a little bit different procedure as to how you can call in and find out about all of the options that are available. I highly suggest that you do whatever possible to get to somebody who can tell you everything you can do with that plan, because I'll tell you right now, the carriers are going to send out and even go so far as to highlight or, subtly recommend the most friendly option for the carrier, right? We're seeing those rate increase options evolve over the last 5, 10 years, right? We're even seeing things like Genworth coming out with a stable premium option. There are all sorts of options that are being offered, and there may be better ones lying in wait. So sometimes you have to have the client on the phone when you call the carrier to go through those options. Sometimes, as their agent, you might just get right through to somebody who can tell you what you can do. But I think you need to put your consultant hat on, knowing what they have, knowing what their situation is, and knowing what you need to do from a client directive. You should have what you want to do with the plan to modify benefits if you're going to do that in mind before you call the carrier. and they will give you an option of like what all is truly available. Like you may want to reduce inflation protection from 5 compound to 3, right? If you can do that. It may not be offered on that letter. It may be an option when you call the carrier. It may not, but it also may, right? So you want to make sure that you are being the quarterback for your client and understanding what might be a really good cost saving measure for them. If they're like any of Phyllis's clients who are up to 500 a day daily benefit, and you can reduce the inflation protection because they're into their 80s now, that is something I heavily, heavily recommend, just to go that extra mile for the client because it can be a big deal not only for CYA for you down the line if they need care, right? But also just for the client. You don't want them to cut benefits or, like Phyllis said, explore a 180-day elimination period instead of 90, where they're paying for another 90 days out of pocket, and the costs of care are, as you know, just crazy, and it really kind of makes the numbers not make as much sense.
And if they're in their 80s, Jason, yes, you can give up the inflation if that makes sense, if their other benefits are so high. And that won't make them lose their partnership status because 76 and up, inflation's not required. So
Right, right,
Phyllis, to your point, um, and we both have clients that are in their 80s. I find many times they've all forgotten that if they go on claim, the premium's no longer an issue because they go on premium
yeah,
waiver. You
always
know,
put that in.
so,
What other
so
insurance does that?
right. So one of the first comments I'll ask them is, I'll say it's been a long time, and we have got a comment, and I ask them, "How old are you?" I know how old they are, but I want them to hear me say it. And I let them know I've got many clients that are your age and younger that are using these plans, and they're shaking their heads, they're nodding. So I remind them, we can make a reduction, but if you go on claim, you no longer pay the premium. I can never put that back. Okay. So that helps offset an awful lot. Many of them forgot the growth that took the plan. We sold Amex plans back in the day, 5% compound. Those have tripled. They've forgotten how much they've grown. But the
Mm.
other question I ask them is, have you ever shown your plan to your financially legal advisors to review? And they many times have. And I say, what do they tell you? And they'll come back and say the same thing. They said, I've got gold here. And that's a contrareminder to us to number one, whenever we're presenting somebody, do
Mhm.
the best we can, do the right thing. So later on, they can't get unlimited coverage.
right.
They can't get, we used to have restoration benefits an unlimited number of times, then once in a lifetime. Now it's all gone. People can't get these any longer. And somebody who's talking about return on investment, I let them know that if you go on claim, you no longer pay the premium, your benefit could be $600 a day. You could be getting back 18,000 a month. And we do an ROI. It might take you 9 months, 10 months, 12 months on claim to get back everything you paid in premium for the lifetime of the coverage. How many people do you know that have needed care for that amount of time? And sometimes silence is like they're nodding their heads. So, and the last thing I'm going to comment on is you say the carriers provide what you call friendly options. I let the client know they're showing you options that are to their benefit, not
Right,
yours.
right.
Yeah,
You
that's
know,
that's
you
what.
can keep the 5% compounding, but it's a linear relationship between benefit and premium. I let them know we can reduce your benefit by 15, 20%, reduce your premium by that, and it's going to grow back. And based on age, it could be the right way to go. So there are many ways to present it based on their age, their understanding, and the way you design the plan in the beginning.
Yeah,
But some
100%.
good comments, guys.
Amazing point also on the premium stop when you're on claim. I mean, just a completely underrated and overlooked point. If you
Yeah.
end up needing to use this thing, we're not even talking about premium anymore. We're just
And
talking
one thing,
about the benefit you're going to
though,
receive.
the older CNA policies won't stop it on home care. So if you're dealing
Mhm.
with, you just know
Yeah.
that could be the issue.
Right.
But yeah, I do that projection of benefits out to the 80s, but then I say, of course, you could have a claim any day. And when you do have a claim, your premium stops.
Yeah.
Yep.
And would you
And
10,000 a year or 20,000 a month? Which would be more comfortable for you?
right. Yeah. And my experience does not go back as far as many of you on the call in the long-term care industry, obviously, but I noticed just over a period of a few years, doing a couple rate increase consultations at least a week, I started noticing that the options being offered in the letter got progressively more friendly for the carrier, right? So they are hoping that
Yeah.
you open this letter, you're no longer connected to your long-term care specialist, and you feel as if these are your only options to choose from. I'm tired of paying this premium as it is. So yeah, I understand the importance of the coverage, but I want to pay less, or I want to pay what I was paying before. And they will cook up options that look perfect. If you make this modification, you'll be paying what you paid before, right? And that option is super, super friendly to the carrier. Even the stable premium options that Genworth is offering, they're not a permanent stable premium. There's a period certain on the stability. So it's
And
super
they want you
important.
to take the paid up, Jason.
Yeah,
That's what they want people to do.
they do. Yeah.
Buy them out, get them out of here.
You wanted to be out of this plan anyway, we'll pay you to get out of it,
Yeah.
right? And, that's why we exist, right? To be able to help the client understand these are things that the carrier wants you to do. You've gotten a great deal. Hold on to your great deal. Keep keep the merit, the crowning value of the good decision you made at the end of the day. The reason the carrier's coming back now is because they can't deal with how good of a deal you got, right?
Mhm.
Um, and I think it's just also about how we set up the conversation in the pre-sale for
Mhm.
clients going forward. If we, you know, yes, we've had an era of rate increases. Yes, we've had old policy blocks that have had rate increases on them. Yes, it feels as if the industry and actuarial has recovered and learned from a lot of those mistakes to make sure we don't have an environment like this going forward, but it's not guaranteed. So it's something you still have to make sure you're setting up with clients in the pre-sale now that we're armed with this knowledge to make sure that if it does happen again in the future, there are no bad surprises. There are so many new long-term care products out there that have their own actuarial science behind them, their own pricing behind them, and not all the premiums are guaranteed. So it's important to still set that up in the conversation. I can tell you that the industry is in a better place than it was, as far as actuarial assumptions and assumed lapse rates, things of that nature, but I can't sit here and guarantee that we're not going to have a rate increase on X, Y, or Z policy. Diane, do you have something you wanted to
Yeah.
add?
Yeah. In addition to what you just said, being proactive about this, I think, is the most important and in the selling time and later. And I'm always telling my clients if we're talking about traditional, we're talking about future rate increases and that we have to plan for can we afford it today and can we afford it 20 or 30 years from now? And buy as much as you think you can afford then. And if there's a rate increase, then we'll work on
Yeah.
it at that point. So, like, and I tell them we bought unlimited benefits when we were 35 with the idea that if there's ever a rate increase, we can knock it down to 8 or 10 years and still have a really beautiful policy. Thankfully, we haven't had a rate increase, but but if there is, that was the plan when we bought it, was we have a plan B if something happens. And then I always, it's as much as I can, make sure to call my clients before they get that letter because we all get the notices ahead
Yeah.
of time. And if I call them and leave them a message, even, hey, you're going to get a letter in August with offers, don't take those offers. Call me first and let's talk through it. And then they always, I mean, almost every single one says, thank you for reaching out to me before I got that letter
It's
so I
huge.
wouldn't be as angry as I thought I was going to be.
Right. If you can stop somebody from being blindsided, all the better. It should be part of your practice if you have the visibility to be able to do that 100%.
Well, we have a lot of reasons for getting involved. One of them is, unfortunately, as these companies stopped offering plans, customer service went offshore. And we each know what it's like to have to get somebody on the line from a particular company, whether it's Hancock, Genworth, whomever, and speak on behalf of the client. Can you imagine what it would be like if the client had to go through all that and get on hold?
Right.
My God, what happens if you have to put in a claim?
Right.
And some of these carries, I mean, nobody's, from my perspective, better between Genworth Pro and customer service than Genworth is. They'll keep us apprised when somebody's delinquent on the premium, the policy in danger of lapsing, a benefit option went out. On the other hand, you got a company like MedAmerica that doesn't even notify us when a policy is delinquent or it's going to lapse. And we've got to go on their site to do it, which we should be doing. So as long as the company's in business, we've got a good backup team in most cases. But once they go out, guys, just be careful.
Many keep a skeleton team in place, but at the end of the day,
Getting worse.
uh, you
Yeah.
know, yeah, you're right. Your chances of getting on with somebody, you know, before a 2 hour wait, right, is how
Yeah.
slim. You're right.
Mhm.
Totally agree. And yeah, to your point, Diane, just being that proactivity is huge. And I think, you know, letting people know about the potential for rate increases doesn't have to be something that scares them, right? You can set it up. You can have that conversation in ways that say, again, there's lots of industry protections in place, there's regulation in place. The CEO of a carrier can't roll out of bed one morning and say, I have decided to levy a rate increase on XYZ policy blocks of business because I don't like the performance. It's not how it works. They have to actually petition the state insurance department for a rate increase on a specific policy block. They can't target anyone in particular. And at the end of the day, the state insurance department can say yes, no, or yes, but not at the level that you're asking for. I'll approve a smaller rate increase, right? So the more you let people know about the process, you know, and the more you remind them that this is a valuable plan. I'm just being transparent with you. I can't sit across from the table with you and tell you that there's not going to be a rate increase. That can just go so far in just helping the client understand and keep people from getting blindsided. Um, but I really appreciate all the personal experience everybody has imparted. Anybody else have anything to share, or um, are you maybe dealing with a rate increase recently for the first time or the first few times? I always want people on the call who are newer to not feel left out in any way just because they're not dealing with this an awful lot. There are people on this call who can help you who have probably no lie, 500 to 1,000 of these um, have been gone through. Everybody's situation is different. How you consult each individual client has to be different, just like when you're selling long-term care insurance in the first place. Um, but in many cases, again, you're trying to help somebody keep an underpriced plan that has immense value, really beyond measure for professionals like us who are working in new business every single day, right? This is value beyond measure compared to what I could provide somebody today for this price, right?
Throw out a sales tip real quick. And yeah, I'm handling a lot of these. People find me on the internet and they have a rate
Yeah,
increase. Help a lot of people. But one thing I'm using on the newer products like NGL or Manhattan Life, they've had 5 claims. They
right,
don't have the baggage of
right,
all the older stuff that was priced too little. And that helps. You can't guarantee people they won't have a rate increase, but the likelihood is much less than carriers who are still trying to make up the deficits. And the other thing going on is when the insurance department for each state doesn't approve what they're asking for, then they have to keep coming back and coming back. And that's why California was so screwed up. California waited so long. And then with Prudential, when they finally did approve something, the rate increases were just unimaginable because they couldn't get it when they needed it.
right. Yeah.
So
And I think it's it's very, very simple to assume that the average American has really no clear idea as to how insurance products are priced and
mhm.
what that actually means, what goes into that, what that means for the future of plans. I don't think you should throw the whole book at them, but I think you should give them an idea of how it works and how they've kind of ended up in this situation where they're dealing with a rate increase, right?
I tell people, $40 a month is too expensive. If we don't know what it is, it's too expensive.
Right.
My job to explain to you what you're getting for $600 a month, but let me show you what you're getting.
Right. Yeah. That's something that's been at the heart of our calculators, right? At the heart of what Lori was talking about with her consultation on rate increases is knowing the price, knowing the premium is a very incomplete one half of the equation, right? You have to know the value you're getting in exchange. And I think, this can giving a little education on this side of the business and how products are priced can really help people understand a multitude of situations that they're in. Why is the underwriting so difficult? Well, if we had looser underwriting, we would have much more expensive plans or much less rich benefits. There are levers that insurance companies pull as far as what they're strict on and what they're not that allows them to price a product a certain way, right? And that's kind of how we're sitting here. But just to kind of sum it all up and I'll set you guys free after this. The way I see it combined with everybody else's advice is number one, start with empathy. Understand your client's emotions, meet them where they're at, let them know that their feelings are normal. Add Diane's advice in there. If you have visibility to let them know ahead of time so they're not blindsided, that cuts down on the negative emotion for certain. So start with empathy and then give them some perspective. Give them an idea of the history of the industry. How did we end up here? What's a little education that I can give you to help you understand where we're at today, right? Give them perspective on how good of a deal they have, and then consult, right? Everybody's situation is different. Everybody makes it to age 65, 70, 75, 80 in a different financial picture. Whether they own the same exact policy with the same exact benefits or not, everybody's picture is different. Some people can afford to take the rate increase comfortably. Some people cannot and need to make modifications. But I think this is really where you earn your paper as a long-term care specialist. This is really where the value is that most clients don't know about, right? On the back end, the client has this huge headache and they're going through a lot of emotions, and you're able to be the quarterback and really take them to the best possible outcome given the situation that they're in. Not many people know about that, but I want you to know that if you are somebody who is actively working through any of these issues with clients, you need to believe and understand that you have immense value as a financial professional and you're helping people keep very important coverage that can help them down the road. I think, long-term care specialists don't get enough credit. They don't get enough thanks. This is one of the major things that long-term care specialists do that is just so, so valuable that kind of flies under the radar for me. Um, let's see what we got in the chat just before we wrap it. Tell financial planners or dabbling agents to send their clients to me for help with. Yes, 100%. 100%. Because we do the financial advisor session, right? Working with financial advisors as a long-term care specialist. We do the self-funding conversation, things like that. And one of the things I try to say is your value to financial advisors is incalculable. Rate increases are one of those things that's a great way to meet more financial professionals. If you've got somebody who's got a client who's struggling with a rate increase, they're kind of orphaned from their long-term care specialist, and their financial professional is, getting these letters and all of a sudden having to deal with it. There's a headache you can take off their plate. That's value that you can demonstrate. There's more referrals that you can potentially gain. This person knows their stuff, not only up front, but on the back end of how to deal with long-term care policies. So I think that's awesome. Lori says, for most of us, except the lucky duck, who said she's never had a rate increase. Yeah, Diane, I would say that is lucky duck territory. Good to talk about our own rate increases and how we've handled them over the years. We always have options, still stinks, but we always have options to meet the client's current needs. I think that's fantastic. Personal stories always go a really long way. My Unum premium has quadrupled from $80 a month in 1993 to $330 a month today. And how many more times underpriced do you think that plan still is today where it sits, Phyllis? Incalculable with unlimited benefit, right? You cannot calculate that.
No way.
Right. So yeah, that personal story is a great way to get people to understand, hey, I've been through it too. This is how I handled it, right? And I still believe there's way, way more room for that premium to increase before I feel like we're going backwards in value. I feel like it may never, right? Um,
Wait, I think one thing we have not mentioned, I didn't hear anybody say, some of these buyouts are very large. And maybe if they're healthy, they could take the buyout and get a hybrid with 10-year guaranteed premium or something like that. So not to be overlooked.
Super good point. I mean, there still is justification in certain cases for replacement,
Mhm.
right? Especially when we're seeing all these new types of products coming out there. Phyllis, you mentioned a short-term care pivot for a
Mhm.
client who's
That's
having
the
trouble keeping
recovery
up.
benefit. Yeah.
So those options are out there. They just tend to be a lower percentage of the time that we end up taking that route. But it is something to explore. It's something that generally is one of the first things on the client's mind. You know,
I have
I
a
still
huge
want
problem.
coverage.
I have a huge problem with some of these buyouts. I had a client that I'd sold years ago. I helped her husband process his claim. He got his things through until he died. She downsized, sold the house, moved. I didn't have contact information for her, and all of a sudden I get a John Hancock letter. She accepted the buyout, $80,000, and they're buying the policy back. And I'm thinking, oh my God, if she was in her right mind, she would never do that. And I complained to our NAFA board in the state of Wisconsin about this and was told that some life policies are doing the same thing now.
Hmm.
And if the client is cognitively impaired and they get to buy it, hey, you could get 30 or $50,000. Client says, well, hell yeah, that's a great deal. Not realize they're giving up $1 million. That
Right.
is bad business.
Yeah. And
Yeah.
it's something that has me worrying for clients who don't have specialists like you all,
Mhm.
right? They're going to get that letter and who knows what kind of decision is on the other end of that, right? So,
I contacted John Hancock. They refused to give me her new contact information, and I couldn't find her.
wow. Yeah, I think that's why many carriers, the only way you can kind of get through to understand those options is having the client on the phone with you. Because some carriers will turn you away, unfortunately, if you don't have the policyholder with you on the phone. Not always possible, right? So it is a tough road. Not for those with weak constitutions. Long-term care specialists are kind of a different breed, right? For all the things we go through for our clients, but it's incredible work. Agree with you, Phyllis, that
Clients, Jason, I get them to sign a form saying that they are giving me permission to talk to the insurance company.
yeah, great best practice. If it's not always possible to get on the phone at the same time, just that release helps. Being able
Yeah.
to fax that over, just anything you can do to get that trust transfer because you don't want your clients getting their hands dirty in this way. And
Rather them not be on the phone.
they're not equipped to handle the conversation in the same way, right? They're not able to handle that game of telephone as well as you can directly. So I think there was a lot of great advice, a lot of really good best practices. I think, just bring some of the human element, understand their situation. I know you're frustrated. Let's talk about how we got here and let me put into perspective what you have, and then we can make decisions from there. Is in my mind a great way to do it. Everybody has their own different approaches they shared, but all kind of centered around the same concept. Get people to
Great
understand.
session, Jason. I had to be on this one because this is so close to my heart. You
Well,
know,
I appreciate you being here and imparting your experience as well as everyone else. And, hopefully this helps new agents or, just folks who deal with this a lot, who may have learned a trick or two that they haven't been using before and really help that, make a good outcome for a client or two. So you all make this what it is. You already know. I appreciate you all very much. And next week we're gonna have a guest I'm really excited for. We're gonna have Ramona Neal on. If you haven't heard of her, she is the owner of the Living Benefit Review. Just an incredible industry-wide survey of life products with long-term care riders, hybrid life long-term care plans. I mean, in my mind, like the authority around these plans. We're going to talk about the different long-term care and chronic illness riders that you see out there that are attached to life policies or hybrid policies. And we're going to kind of go through what makes them all different, what to watch out for, so that you can make an informed decision and there's no surprises for your client come claim time. Um, Really important topic and one of the best people in the business to be able to have the discussion with. So hope you'll join us then. But for now, take care, be well, and we'll talk to you this time next week.
Great call,
Appreciate
Jason.
y'all.
Thank you.
Have a good one.